So let's make some sense out of what I just said. Let's see if I can show you some really concrete examples of what the adjusting process does. Okay, remember this little booger? Okay, unadjusted trial balance came right off of the general ledger, right? All of those accounts and those transactions recreated. So now, let's go back here and look. Which one of these do you think we might have to adjust? Do you think we've used, just see, supplies? Could we have used more supplies? Is that going to stay the same? How about the prepaid insurance? Do you think we may have used up some of that this month? Office equipment? Now that's a fixed asset. We talked about that. We may have to depreciate that. Oh, here's a good one. You have unearned rent. Possibility that we may have to adjust that one. Here's a draw that will have to be taken into consideration eventually. I see we pay wages. I suppose there's a possibility that that may be out of balance a little bit as far as when the pay week begins and ends. So, yeah, there's a few things we probably need to check out in this. So, let's go down and see what the next slide shows us. Whoop. By golly, we do have, this is some expanded new accounts they've thrown in on you. We have an accumulated depreciation for the office equipment, so we have to look at that. It looks like we have a wages payable. It looks like that may be adjusted. Rent revenue, that would be for the unearned rent. We're going to have to do something with that. There's our depreciation expense, which goes with the accumulated depreciation. And yeah, I was right. Insurance expense has to be recorded. So those are our adjustments. Let's go see how we do them. Okay, first of all, they went and they looked at their supplies on hand, and they found out they only have $760 worth of supplies, which means they've used $1,240 worth. That needs to be adjusted. So if we go to the next slide, you will find this is how we adjust it. Okay, we're going to increase the supplies expense here by $1,240, and we're going to decrease the asset by $1,240, which is our supplies account. And you can see when we do that, we are keeping things in balance. I'm crediting here, and I'm debiting over here in the expense side. So let's see what comes up next. The other one they want to do with this one is prepaid insurance. It's for 12 months. So each month, if I divide 12 into 2,400, is $200 worth of expense. So again, you're going to do a general journal entry of interest expense, 200, and prepaid expense, 200. See, we're going to take it away from the prepaid asset. So again, if you look at the accounting equation down here, the asset is credited, which decreases it. The expense on the owner's equity side is debited, so that's increased. You can see how we're keeping things in balance. And what did we just do? Now, if I hadn't made those two adjustments, my expenses would have been understated by $1,440, and my net income then would have been overstated because net income minus revenues minus expenses equal net income. So if my expenses were not fully shown, I would have shown more income than I should have. If I look at the balance sheet, the assets would have been overstated because we would have had too much money in the prepaid interest and too much money in the inventory, which then would have made my owner's equity overstated. So you can see, just by not doing the adjustments can really mess up the income of the statements, both income and balance sheet. This one we're looking at unearned rent. That's unearned revenue. We had unearned rent on the books at $360, and that was for 3 months. For December, January, February, yeah, 1 month has gone by, so that's $120 in rent that we have to recognize now. Now, rent is a credit, it's a revenue credit, and the unearned revenue, unearned rent revenue, is going to be a debit. So we've recorded that, and you can see here's a liability. We are decreasing that liability, and we are increasing the rent revenue on the owner's equity side. Now, what would have happened if we didn't do that? Well, our revenues would have been understated by 120, which means our net income would have been understated by 120. And then if you look at the balance sheet down here, liabilities would have shown $120 more, and owner's equity would have been understated by 120. So that one little adjustment makes a big difference. The next one we look at is another unearned revenue, and this is a different kind. This is one that's never been recorded. They've have a contract to provide services for $20 an hour, and as of December 31st, they've provided 25 hours of services. And the revenue's not going to be billed until January 15th. So they're going to create a fees earned here of $500 with a credit, and then create an accounts receivable of $500. Again, you can see it's increased the asset side, and it has increased the owner's equity side, so everything is in balance. Now, what would have happened if they hadn't have done that? Well, that $500 wouldn't have been on the books, and their revenue would have been understated. That means net income would have been understated. Assets would have been understated, and owner's equity would have been understated. So that makes a big difference again. That adjustment's very important. Here's the other one. This is the accrued wages. There are 2 days that are in this period that they've got to pull out, and they figure that's about $250 worth of wages. So they're going to do the same thing as the other adjustings. They're going to create, or they're going to add to the wage expense account. They're going to create a wages payable account, and then you can see again our accounting equation is in balance. We have increased the payable, and we have increased the wage expense over here. Now, when they go to pay the payroll in the following period, they're going to only have the wage expense for that amount, for that period. They're going to use that wages payable and get rid of it by debiting it, and then this is going to be the full amount of the cash that they pay. So this is sort of a compensation way. You could also have reversed this wages payable as a reversing entry, and we will discuss those more later. Now, what would have happened if they hadn't have done that? Well, our expenses would have been understated, our net income would have been overstated, our liabilities would have been understated, and our owner's equity would have been overstated. So, again, we've went through quite a bit of money here by doing these adjustments and adjusting the state trial balance. And the very last one we look at is a depreciation expense. So you have fixed assets or plant assets that are going to last over a year. They're permanent, they have a very long life. You can't take the full amount of their cost off because you're using them long term. So you would have to look at them and figure out how much to depreciate, and that's what is called depreciation expense for the use of that asset. So as the time passes, the asset will lose its ability to provide useful services, but basically what you're saying is I spent $10,000 for this computer. It's going to last 10 years. It's going to cost me $1,000 in theory a year to use it. So each period I will depreciate $1,000 per year. And then you could break that down even further per month by dividing it by 12. At any rate, remember we looked at the revenue recognition theory and the matching theory with the expense. We have to match those two. So depreciation is always an automatic adjustment for as long as you have a fixed asset. And it's called depreciation expense. And it in the scheme of things, we're going to create a new account called accumulated depreciation. It's increased by a credit, and it's called a contra account. And it is a counter account against the fixed assets. We never typically mark down a fixed asset directly. It is always done through the accumulated depreciation. And here is the next. Here's the actual depreciation expense. You'll have, and they've laid it out, it's $50 per month. So the depreciation expense is debited and the accumulated depreciation is credited. And you'll again see things are in balance. It doesn't touch the office equipment. It only touches the accumulated depreciation for office equipment. You can probably hear my doggies. Somebody just came in. Oh, we're almost done. So the difference between the original cost of the office equipment and the balance of the accumulated depreciation is called the book value. And we will use that when we sell the item, if we sell it, to come up with a loss or a gain. And if we hadn't taken the depreciation expense, again, you can see the effects. Expenses would have been understated, net income over, assets overstated, and equity would have been overstated. So that is the beginning of the adjusting entries. Thank you.